Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the Stock Play of the Day. Today's stock is UnitedHealth Group, symbol UNH. We'll discuss, should we pass or should we play? Hello, everyone. My name is Brian Overby. I am the Senior Options Analyst at Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
All right, Lindsey. Well, let's start with the S&P 500 index like we usually do. I have a chart of it up here. What do you see going on in the markets this week?
Yeah, we got some green this Monday morning, Brian. I feel like it's been a while since we've had a green Monday morning on Wall Street while we're doing Stock Play of the Day. We'll see how the rest of the day goes, but things are looking up this morning. You see on the chart here, a big gap up to that 50-day moving average. I think you and I talk about almost every week how this rebound since that March 23rd low has really been technically driven, and we continue to see that today. And what I think we're hoping for, many investors are hoping for, is that we can get the S&P 500 above that 50-day and we can stay above that, because as of late, the 100-day as well as the correction level, whereby the market will have declined by 10% since that September 2nd high that you see there on the chart. Those two levels have really been acting as almost levels of support in a sense for the market. The S&P, what did it do? It closed, it fell to its 100-day moving average on Thursday of last week, but bounced right back off of that. So, those are some of the levels that we'll be continuing to watch going forward. If we can have this sustained, like, perhaps we can get above the 20-day and continue to gain some momentum going forward. This may have just been your typical classic correction that you do see quite often. It's a very frequent occurrence in bull markets, Brian. So that might be what we're kind of going through. With regards to today specifically, you are starting to see some of those stocks that are levered to the reopening trade do well. So interesting, like a Carnival and American Airlines are up solidly this morning. And this is coming off of what has been a horrendous month of September for the stock market. The S&P 500 down 5.8% in the month of September. The NASDAQ has taken it even harder on the chin, down 7.3% for the month of September. But you know what? September has historically been a very weak month for the year. Actually, if you go back to 1950 on average, it has always been the worst month. So this isn't all that surprising. And as an investor, these are the types of places you can look for opportunities. You can whip out your wish list of stocks or ETFs that you've been looking at and try to find opportunities when the market falls like this. And, we're here to provide some ideas, at least from an options perspective, creating the tape trades we talk about each week. So we're glad to have you with us, and we're glad to be here to help. But yeah, so far the market this morning looking strong. I will say, while the NASDAQ, I forgot to mention the NASDAQ, while it's down the most of all the indices in the month of September, it's been pretty rough for the tech sector, down that 7.8% in the month of September. It did have a positive week last week, while the S&P 500 had its fourth negative week in a row. The S&P or the NASDAQ had a positive week, up just over 1% after 4 of its own weeks in a row of decline. So perhaps this is changing the tide. Only time will tell. As we all know, markets can go in any direction from here, but we'll be here to guide you through that process. Now, Brian, the other thing you and I have been keeping our eye on has been the VIX, and that remains stubbornly high right now. It's just kind of been in this range for quite a while. What, again, do you make of it? And what are you seeing? What are the futures contracts telling you? And what, as retail investors, should we take from that.
Yes. Now, on the VIX, you're right. Stubbornly is a good word to describe what the VIX is doing. We see the VIX up again today, trading at 2680. But we've been highlighting this a little, well, almost on the last couple of stock plays of the day, that the futures contracts keep seeming to be climbing going into the November election and also going into the new year. So we see in my VIX watch list that I'm showing here on the Ally Invest dashboard, the VIX October expiration is trading around 31% implied, where we got the VIX right now, the spot, the index is actually at 27% implied volatility. And then November, obviously we got the big election in November, and that's trading as high as 33% implied volatility. And then January and December, both over 30% also. So the marketplace, even though we've been setting some new highs in the S&P 500 index, not that long ago, we had a little bit of a pullback, but overall, the marketplace is uncertain about what's going on. And that's without a doubt. So we're paying up for option contracts, both on the calls and on the puts, on stocks, on all underlyings, because of these increased and implied volatility. And the futures contract is saying that this increased implied volatility should be going all the way out into the new year. So more uncertainty in the marketplace is what it's looking for, as opposed to less right now. And it is just kind of the marketplace usually has that inverse relationship. If we see the markets going up, the VIX usually comes down. But as Lindsey said, it's just stubbornly hanging above that 25% level, which over all the years, it's a mean reverting index. So normally the VIX would, as the market sets new highs, the VIX would start coming back down, going down towards that 15, 16, 17% level, which is more of its mean, more of its average. Not to mention, if you go up further in time, when that's the case, definitely don't expect more volatility. You expect it to rein in when you're trading at around 25% implied volatility in the VIX. So a lot of uncertainty out there, and it's being reflected in all the option contracts, not only on the indexes, but also on the underlying stocks. All right, so today's stock, UNH. Let's talk a little bit about UnitedHealth.
Yeah, sure thing. Well, before I get into that, two things. One, I just want to remind our viewers that we are going to take your questions at the end of the show here. There's a chat box on the right-hand side of the video screen there. Brian and I are happy to take any questions you have. So feel free to type in anything that's on your mind there. We'll get to as many of questions as we can at the end of the show. And the other thing I just thought of while you were talking there, Brian, is that a VIX at 33 for November typically implies about a 2% average daily move in the index over the next 30-day period. So these are big moves in market to be continued through November. So anyway, just a little tidbit there for you. But let's dive into UNH. It is our stock play of the day. We've got a chart up here for you that we're showing you. It's Friday had a really nice jump higher. Today we're up a little bit, I think, this morning, which is nice. We want to talk about the healthcare sector because we haven't talked about it in quite a while. What we had seen was, if you look at the S&P 500, we don't have a chart right here up right now, but the S&P 500 healthcare sector is down about 5% off its September 1st high. This stock in particular, UNH, it reached a high in August, which is, I think, in the middle of this chart here, August 14th. So we're still 5.5% below that level. So we thought it would be interesting, and the reason to look at the sector and then potentially talk within the sector, we picked UNH just for today's paper trade. But there is some impact. There's some outside pressure that is impacting the healthcare sector. And that has really been the death of Ruth Bader Ginsburg, the Supreme Court justice. She's very liberal. She recently passed away, and the timing is not the most opportune for the healthcare sector, shall we say. As a liberal justice, leaving the bench, the president has the opportunity to replace her with somebody else that will take a new lifetime seat. Over the weekend, we heard that President Trump has nominated Amy Coney Barrett to be her replacement. She obviously has to go through Senate proceedings to be confirmed, and that usually takes some time, 2 to 3 months. But there's going to be an expedited effort behind this. So the proceedings are expected to start October 12th. And the reason I'm giving you this timeline, stick with me here, I promise I'm not trying to bore you, is that November 10th is when the Supreme Court is slated to rule on Obamacare, or the Affordable Care Act, as an individual mandate that's supposed to make its way through the Supreme Court. And the question is whether the High Court is going to allow that mandate, the individual mandate within the ACA, to be severable from the overall ACA or Obamacare, or if it's going to have bigger implications for Obamacare in general. So the question is Obamacare eventually going to be dismantled? We know that President Trump, it has been something that has been on his target list since he became president. And so the timing is just all very interesting with the presidential election coming on November 3rd. A lot of things happen very quickly, creating a lot of uncertainty for the healthcare sector, because if Obamacare is overturned, then that has negative implications from a revenue perspective for the sector, because there'll be less people that are insured, therefore less people paying their bill, less revenue for hospital, less revenue for insurers like UnitedHealth Group. So we've seen the whole sector come under pressure, and there's a possibility that the pressure that the sector and the stocks, as well as other stocks, are seeing could be a little overdone. So we thought we'd take a look at it. The great thing about looking at options is you have the opportunity to make shorter term trade decisions, rather than if you're investing in the stock for the long term or the long haul. Now, I will say UNH is a high quality healthcare company. They're always one of the first to report earnings for the sector. In fact, they announced today that they're reporting their next quarter earnings on October 14th. So that's coming up very closely, just a couple weeks away. The stock had a nice run off of its second quarter earnings reports that came out in July. And what they saw is the numbers really were blown out of the water, because they did see a return to normal patient activity, at least by the end of the second quarter, that was expected to carry through to this quarter and the next quarter, after the quarter prior, whereby there was a major slowdown because of the pandemic. Patients weren't going in, elective surgeries were canceled or pushed off. There was a lot less activity in healthcare hospital space, and a lot of these companies were negatively impacted on the top line because of that. We're starting to see a rebound of that, and as we are seeing COVID cases starting to tick up in the last couple of days here, but the market has I think that's also another reason, part of what the more recent pullback in the sector was related to as well. A little less so probably than the SCOTUS topic, but anyway, this is a stock that is a high quality name, has a decent dividend yield, I think 1.6%, and is expected to report pretty decent earnings in the coming quarter, again in October. So it's one that we've got our eye on. It seems like it's picking up some momentum. If we look at that chart again, I think Brian had some of the moving averages up there. This is also picking up, just like the S&P 500, breaking through that 50-day today. We'll see where it closes. If in the next couple of days, maybe we can get above that, then the momentum could be sustained for a little bit longer. Anyway, this is one we're going to look at. Good management team, high quality company. They did reiterate their guidance for the rest of the year when they reported last quarter's earnings, which might be conservative if patient activity picked up, at a higher pace than they may have anticipated. So it's something that we'll keep our eye on going forward, and we wanted to highlight to you guys today. So with that, Brian, what are you thinking from an options perspective if you have a shorter time frame?
All right. Well, I'm looking at a butterfly today, and I really want to, you mentioned that earnings date. We're just going to kind of avoid that earnings, and we're going to do a trade that's going to try to take advantage of this recent momentum that we've seen in the underlying stock. It's going to be a short-term speculative trade. We don't want to spend a lot of money on this trade overall, so we're going to do what's called a butterfly trade. You could call it the Notorious RBG butterfly if you would like. And that the reason why we're doing this trade is that the stock did get beaten up after the news about RBG came out, and now the stock is actually building some momentum back up to the upside. But it's a very expensive underlying, which means the option contracts are also expensive. One thing that you can do with long butterflies is you can take a targeted approach, pick out an area that you think the underlying stock may land in, and that's your goal here, but you're not going to put a lot of money up front to do the trade. So we're seeing a long butterfly spread here inside the options playbook. This is the Ally Invest options playbook. And the underlying stock, when we look at the profit and loss graph, is going to be down here around strike A or a little bit below that. So what we're hoping is that we can put this on for a reasonable amount, and that the underlying stock will come and finish somewhere between strike A and strike C. Now, on the longer term outlook, if you're thinking about using UNH, you could go out longer in time and actually look at buying a long-term call option. That would be an alternative. But today we're just speculating on the momentum. Now, it's not meant to be a recommendation. We're just doing this as a paper trade. But the reason why we're discussing a butterfly as opposed to just buying a call outright is the sheer cost of the option contracts in this highly volatile environment and on an expensive underlying. So let's get to the Ally Invest option chains. And here we do see that United is up $3. It was up $9 on Friday, if I recall, on the close. And now it's at 305. So the fact that it's a $305 stock will add some juice to the option contracts. I'm going to avoid that earnings expiration. We're going to go out to the October 9th expiration, which is only 11 days away. And I do not mind if you were going to do this, to do it on the 4-day to expiration. You're just going to have to pay a little bit. You got to pay a little bit up for that. And it doesn't give a lot of room for speculation on the upside. I think 11 days is a kind of a sweet area for butterflies. If you're correct on your forecast, you want to be closer to the expiration date. In other words, if the underlying stock does go up towards your middle strike, the strike that you're going to be selling in your butterfly, you will be rewarded more if that move happens closer to the expiration date as opposed to sooner in the process. So let's look at the butterfly that we have set up here. Going out, as I said, 11 days, October 9th expiration. One of the things that we want to look at when we're putting a butterfly together is we want to make sure we don't go too far out of the money. We want to be in a range that the expected move of the underlying stock says it can reach. So I always start by looking at the 305 strike. If I bought the 305 call, or the most at the money strike, I could rephrase it as the most at the money strike is trading for $7 on the call, $6 on the put. So we're looking at about a 13-point move by this expiration date. That means the underlying market thinks that that's a feasible move. It's kind of the line in the sand. It's the over-under, if you want to look at it that way. So we don't want to go too much further out than that, because that's a potential move based off of what the marketplace is telling me. So if I scroll and I look at this, 305, we're going to go about 10 points out. We're going to start at the 315 level. The expected move is around 13, so that is feasible. But the further I go out, the cheaper it's going to be, obviously, because you need a bigger move. So the butterfly would be a little bit cheaper. So I think that's a decent place to be. We're going to buy the 315. We're going to sell the 325. And then we're going to buy the 335. Now, note, if we just bought the 315 outright, that would be trading for $2.41 on the ask. If we look at the butterfly, if I scroll down to the Ally Invest option strategy workbench, we see we reduce that cost. We put it down to $1.17. So it is a speculative paper trade here. It is a speculative trade mainly because we're hoping for a decent move in a short period of time, even though the options are saying that it could make that move. But because of the short time frame, it makes it a little bit more speculative. We don't really want to pay up for the option contracts because they're fairly expensive. So we're going to do this butterfly, and we're going to hope that we land somewhere between the 315 and the 335 strike. Midpoint is $1.20. Let's officially make this our paper trade for the week. And I'm going to do that by clicking on the trade button and putting it in the right rail. And we see here we're buying the October 9th. We're using the October 9th expiration for all the different option contracts. We would be buying one of the 335, selling two of the 325, and then buying one of the 315. Now, you'd work this order a little bit. You'd want to get somewhere close to the midpoint. We'll call it $1.10, if you will. That looks like a solid price to put in. Never guaranteed a midpoint fill, but if you have three legs, you got to work the order. You never really want to enter this order at market and just buy whatever the prevailing price is. So I'm doing this trade hoping that I can get a fill somewhere in the midpoint. If I do fill at 110, that's going to be my max risk. So for every 1 by 2 by 1 butterfly that I do, for every 1 by 2 by 1, I'm going to pay $110 plus commission to put on that trade, and that's going to be my max risk. Now, what's my upside? Well, in theory, the upside would be the width of the spread, the width between the strikes on the butterfly, which is 10 points. Now, you're not going to make that 10 points because if it gets to that short strike, you're going to close it. You're going to want to get out of that trade prior to it actually getting to that short strike. But if we do that, the maximum this could trade for is $10. You subtract what you paid, which is 110. And that means that the maximum that you could make is $8.90 or $890 overall. So let's scroll down and let's look at the profit and loss graph on the butterfly. This is a little bit more advanced paper trade that we have this week for the stock play of the day. But once again, when we're learning about trades, you got to explore a little bit when you're just doing it on paper. And that's part of the reason why we're looking at this type of trade. And there's over 40 different strategies inside the options playbook. And I think one of the hardest things is trying to decide, well, based off of these pricing conditions, expensive underlying, fairly volatile underlying stock, expensive market, just in all, looking at what the VIX index, like we talked about earlier, being up over the 25% range. What's a strategy that I can do to speculate a little bit on the continued momentum of the upside on UNH? And this is one of the trades. So if I look at it, here's the underlying stock. This is the profit and loss graph inside the Ally Invest option chains. Right now, the colored line is kind of showing you what the profit and loss would be if you were correct on your forecast. Underlying stock is represented by where this gray line is at, right around 305. We'd like it to come on up and land somewhere within this range. But you can see now, I'm going to cut this all the way down to like 1 day remaining to expiration. And if I do that, you now see that the profit and loss graph changes quite a bit. And this highlights the fact that if I am correct on my forecast on the butterfly, I would rather be closer to the expiration date as opposed to right away. So now, if I'm doing this trade, and we'll see the trade over here in the workbench once again, if I'm doing this strategy and I'm paying $1.27 for it, I'm not trying to make that $10, that maximum, that $8.90, $10 minus the $1.10 that we paid for it. Because if you're doing that, you're basically just got to get lucky. That would mean that the underlying stock has to stop right at your short strike, right at expiration. So be realistic about your profit and loss here. If I'm doing it for $1.20, if I can double that money, I probably want to get out. And this is one of these trades where you're really not going to manage it. You already have 3 legs on the trade, so you're just putting it on. If it ends up coming back and landing somewhere in between your 2 long strikes, well, that's great. If not, it was only $1.10 that we put into it. So just manage your risk that way. So on the upside, I'm hoping to make, if I could sell this for $2 or maybe $3, I'm going to be right in that range. I'll give you some flexibility. That's when I would want to get out of my paper trade. And on the downside, I'm really not going to manage it. If the underlying just goes down or goes away from this butterfly, oh, well, we managed our risk by doing a butterfly in the first place. All right. Well, let's get back to the listener questions that we have. Lindsey, I'm sure we got a few out there.
Yep, we got a couple, and be sure to type in your questions in the chat box if you do have some, and we'll try to get to as many as we can. We'll start with Scotty B. He says, what is the purpose of buying the 335 call.
Buying the 335 call?
Yes.
Okay. Oh, okay. So if you're doing a spread, you would buy the 315 and you would sell the 325. Now, if I do that trade, that's going to be more expensive than the butterfly. What we're really doing when we do a butterfly is just a combination of two spreads. We are buying a long call spread and we are selling a short call spread. And we can take that credit from the short spread to help pay for the long call. So the reason why we're buying that 335 strike is that we're protecting ourselves because we're selling two of the 325 strikes. So the biggest thing about doing the butterfly overall is by selling a spread to pay for a spread, which effectively creates a butterfly, you are lowering your overall risk when you first put on that trade, as opposed to just doing a long spread or buying a call outright. Great question, by the way.
All right. I got a question from Kristen Greenwald. Why did you choose that expiration, Brian?
All right. Well, the October 9th expiration, it has everything to do with the profit and loss graph, and we can actually show it here. It has the fact that if I do a butterfly, I'm selling two options that are on the middle strike, and I need those options to get some time decay for me to be able to max out. So going out 9 days gives it a little bit of time to run out, but not too much time in case it does run out. So if I did anything, I would actually go a little bit shorter and maybe use the 4-day to expiration. But then again, you're looking for a fairly substantial move over 4 days, and that's kind of hard to get. So the expiration has everything to do with the fact that we're selling two option contracts that we need to decay a little bit for us to get closer to our max profitability on the trade.
All right. Murray asks, can you talk about the rationale for a butterfly versus the iron condor?
All right. So now a butterfly is picking a specific place. If I'm doing an iron condor, I'm doing it to try to just basically bring in a net credit to the account. So let's talk a little bit about what an iron condor is. If I was doing an iron condor, that means I would be selling a put spread and selling a call spread. I'm going to bring in a smaller net credit to the account, and the risk reward is going to be the exact opposite of the butterfly in that I'm going to bring in a small net credit. That's going to be my maximum upside, but I'm going to have a fairly large amount of risk. Where in the butterfly, by doing the butterfly and trying to pinpoint a range that, or I should say a specific point where that underlying stock might land, I'm going in and I'm going to spend less, have less overall risk and give myself more upside. So it's all about, we're speculating here on a bounce back. We're going to manage our risk as opposed to doing something like an iron condor where I'm putting on that trade and I have a high probability of success. But if it goes against me, I get hurt very quickly on an iron condor. And you can actually look up iron condor here. I'll show my screen. I think Jeff's showing it for us here, our producer. And that's inside the options playbook. And here is where is my iron condor? Of course, I don't see it. Long condor with calls. Okay, here's the iron condor right there. All right. So if you want to learn more about the iron condor, you can check it out. But you see, you have a much wider space where you can be profitable on your trade.
All right, Brian, we've got time for one last question. Wayne's asking me, have you heard? I've heard that corporate buybacks have had an influence on previous market recoveries. How much of an influence will that have on our current recovery? It's a good question, Wayne, because a lot of corporations, as we were entering into the pandemic and the market was falling off of a cliff, decided to suspend their buybacks, and some even reduce their dividends. So it's definitely a trend that we have to keep our eye on. And in the last couple of weeks, interestingly, a couple retailers have recently reinitiated their buyback programs. So that's kind of a sign and a vote of confidence by corporate America that the recovery is on its way and moving in the right direction. So we view that as a positive sign. The more companies that do it will obviously benefit corporate earnings. Earnings, by the way, have been moving higher for the S&P 500 over the last several weeks going into this reporting period, which is unusual, but also a sign of it is an encouraging sign that once again, like I said, that the economy is moving in the right direction. So any buybacks obviously helps boost corporate earnings profit growth. So it's a trend we'll keep an eye on, and it's definitely a positive trend coming out of a recovery. Positive. All right, that's all that we have time for today. Thank you all for tuning in and spending the morning with Brian and I. Be sure to check in on Friday. Brian is going to review this exact trade on his Stock Play of the Day Overtime show on Friday at noon. And, he's going to look at the trade and discuss any ways that it might, you could possibly adjust it after a few days in the market. It's just a really good way to catch up and stay on top of the trades that we're looking at. So we look forward to seeing you Friday. And again, next Monday, we'll be back here with the new Stock Play of the Day for you. Right, Brian?
That's right. So make sure you tune in this Friday and make sure you click subscribe and ring the bell so you get all the alerts. Thanks for coming, everyone.